All right, in this video, we're going to pick up with our property bucket cash flows. And so this is all of the cash flows that come from running the property. So that would include things like the rental income. So if you're thinking about the positive side of the ledger, so to speak, we got rental income, cash flows coming in from renting the property. We got reimbursement revenue, perhaps, if we're an office tenant and we got some reimbursement income. If it's a retail tenant, we got triple net leases. If it's an industrial lease or industrial building, we got industrial leases that have reimbursement revenue. So we got to count all the money coming in, including any other income. So if we've got storage income, parking income, laundry income, rooftop lease income, whatever the case may be, all of that is money coming in. And then we need to think about all the cash flows going out. So we got things like operating expenses, so the management fee, the property taxes, the insurance, et cetera, et cetera. Once we take all those things into account, we come up with this line item called the net operating income, really important line item in real estate. And then what's called, or what's termed below the line, by the way, is this net operating income line. It's kind of like the bottom line, a lot of times it's talked about. So below that line, that's strange to say below the bottom line, but below that line we have what's called the capital expenses. So any capital improvements would also be a cash flow that we take into account. And any tenant improvements or leasing commissions, those are cash flows that we have to pay as an owner to kind of bring tenants into the building. So it's not net operating income, but it is property level income or property level cash flows that we need to take into account. So this bucket captures all money coming from and going into the property. And so we need to account for everything that's happening in terms of running the property. So this isn't financing. That's a different thing. No debt service. None of those cash flows. This is just the day-to-day operations, paying the expenses, fixing up things, replacing a roof, everything else associated with running the property. So let's continue our spreadsheet build out here. And let me get the template up here. Make sure this is recording as I hope it does. Okay, good. And we're going to add in the income, well, basically the operations. So let me copy this over here. I'm not going to type it all. And by the way, when I do ask you to build out a pro forma, especially on a test, I will give you a template so that you don't need to worry about memorizing all of these line items. But my hope is that this wouldn't be all that difficult for you to recreate, because I'm trying to do this very logically, very methodically. We're going to have income coming in. We've got all of the expenses going out. Up in the top, we've got our first bucket. Now we're moving on to the second bucket. So we're keeping all the buckets kind of self-contained and letting things go that way. So just walk with me, think through this as I build it. Don't just passively watch this, because you'll learn nothing from it. But if you will kind of engage yourself, think through what I'm doing here, and try to think about why I'm doing what I'm doing, then you'll learn something. So this is going to actually also be another important assumption. So I'm going to go ahead and highlight it in the yellow and do a little circling, because we need to start with some rental income. And so for this, well, hold on, for this cell, what we're going to assume is that we're collecting $3,800 rents. And honestly, I could have put the rental income over here somewhere. I maybe should have done that, but this is just another place to put that assumption. I'll stick it right here. The yellow indicates that it is an assumption. Let me format that real quick. So we got $45,600 as the, and let me move this down to the rental income. There we go. And the rental income is growing, it tells us, at a rate of 5% per year. So I'm going to just refer to the cell next door, multiply it times 1 plus the growth rate of 5%. I need to F for that to lock it in place. And I got a new number. Let me go ahead and format this one because I'm going to copy it elsewhere. So that's year 2, and then I want to go all the way out to year 10. So we have our rental income going from $45,000 a year out to $70,000 a year. Now I've got a few expenses I need to stick in. So the first one is property taxes, and that is right here. I'm going to link to that cell. So negative 6325, and I like this format. So I'm going to paste that format there. And I'm going to copy that format actually all the way down. All right, so insurance. Hopefully this is going to work. Insurance is linked right there. My HOA dues are right there. My maintenance costs are there. And so my net operating income, that's just going to be the sum of all of these cash flows up above. So for the first year, I've got net operating income of $35,150. Now my expense growth rate is 3%, and so I'm going to grow each of these expenses by 3%. So I'm going to say look to the cell to the left and multiply it times 1 plus the growth rate of 3%. I'll F4 it to lock it, and I'm going to keep my formatting. So I'm going to copy that down, and then I'm going to copy that across. And that will knock out all of my expenses. And then I can go ahead and underline that. And then I'm going to copy this formula that just basically says add up all the stuff up above. And I've got my operations bucket, my property bucket taken care of. So we've got 35,000 in NOI all the way out to 57,106. And we have satisfied or taken care of the property bucket. So let me go back to where we were, and we can move on here. So we go to the next slide. The property level property cash flows, we already kind of talked through this. We stuck all those in the spreadsheet. Here's a picture of the spreadsheet as it stands. This matches the spreadsheet that we were just working on. So 57,106 was our bottom line number. So we are in good shape in terms of our cash flows so far. So let's move on to the financing bucket. This is an exciting bucket. After all, our major is named after this bucket. Well, I guess if you're a finance major. This bucket is going to include all the cash flows associated with the loan that we obtain. So we're assuming that we're going to get a loan from the bank, and we're also going to have some debt service payments, and at the end of our holding period, when we sell the property, we have a loan payoff. By the way, if there was going to be a refinance, if we had got a new loan to replace an old loan, that would also be part of the financing cash flows. Now, if we're using debt, we would always, or I'm not going to say always, but we would frequently hear or talk about levered or leveraged cash flows, and we would come down to a levered IRR at the end of the day. So it's important to keep track of whether we are talking about unlevered cash flows, which means the cash flows without any effect from financing, or if we're talking about levered or leveraged cash flows. That's after you've taken into account the debt service. And those can have profound impacts on the returns because financing cash flows can be very large. Now, in terms of our assumptions for the financing bucket, we're going to assume we're getting a 75% loan-to-value loan with a 25-year amortization, a 10-year term. Now, remember, the term of the loan does not have to equal the amortization period. We're going to have an interest rate of 5.25%, and in addition, we're going to pay a loan fee of 2 points. So recall that means 2% of the loan amount in terms of a fee. And the reason we're going to do that is because this actually affects our taxes. And so we're going to throw in another little thing that touches on taxes. But for now, the loan amount is going to be $75,000 of our gross purchase price. That's frequently the way bank loans will work. They will finance part of that those additional costs that you're paying. So our total purchase price is that $583,625. 75% of that gives us a total loan amount of this. If we pay a loan fee of 2% of our loan amount, we're going to be paying a loan fee of $87.54. And if you do the math on the monthly payments required, it would come out to $26.23 per month or $31,746 per year. And at this point, I think we can go back to the spreadsheet and fill in this this financing portion. So let me go back here and let's start populating the financing. So I'm going to just go ahead and copy in my little template piece, and then we'll fill in each of these parts. So we've got some loan proceeds to deal with, loan fees, debt service, the loan payoff, and then we're going to come up with our before tax cash flow or before tax IRR. So these would both be levered numbers. So first off, our loan proceeds. I'm going to multiply the loan to value times the purchase price, and I got a positive number, and that should hopefully make sense to you because we're getting the bank to kick in some money, so that actually is going to end up reducing our out-of-pocket cash flow as we buy this thing. Our loan fees are going to be a negative 2 points times our loan amount. So we're going to have 87.54 in terms of our costs. We've already talked about that. Now we can figure out what our debt service, that means what are our loan payments. So we can just use the payment function, right? Our rate is given up here, 5.25. We're going to divide that by 12 to get a periodic rate. Our loan amortization is 25 years, so we'll multiply that times 12. Our present value is how much we're borrowing. That's $437. Our future value will be 0 if we did in fact pay this over 25 years. And then, because this is going to give me a periodic payment or a monthly payment, I need to multiply it times 12 because our pro forma here is an annual pro forma. So we get $31,476. That's a negative number showing that we're paying it. And let me just get that formatting going, and there we go. I'm linking next door, so I'm going to go ahead and copy this. Because this is a fixed rate mortgage, we're going to have a constant payment along the way. Our debt service is $31,476 every year. And then at the end of this all, we're going to have a loan payoff. So we're going to find out what we'd have to pay if we sold the property at the end of 10 years. What would the loan payout be? For that, we just use the future value function. We've done this many times before. Again, I'm going to go over here to the rate, divide that by 12, do the number of periods. Now we're 10 years into it. I can link here or here. 10 years into this thing. Need to multiply it times 12 to tell it 120 months. My payment has been this divided by 12, right? My monthly payment is 1/12 of my annual payment. The amount I started off borrowing was $437,719. So I am good to go here. Need to format that to get rid of pennies that I don't care about. And we are good. Our loan payoff at the end of this all is $326,296. Now, let's go to this really exciting part where we kind of put together everything we've done so far. We're going to get our before tax cash flows. And these are, by the way, our before tax levered cash flows, or our before tax leveraged cash flows. So I'm going to add up this stuff and this stuff. So we're kind of doing a couple things here. Oops, let me grow that, get rid of pennies. We're doing a couple things here. So this formula, if you see, it's actually capturing the financing bucket and the property operations bucket, because I'm just grabbing the NOI, right? I'm just touching that piece right there, that row, which is going to get the NOI in future years. And the NOI captures all of the cash flows from the operations bucket. So with this nice little blue area, I've got 2 buckets worth of the cash flows. And then up here at the top, I've got the third bucket that we've dealt with. So we've dealt with 3 buckets. My formula captures all 3 buckets. And so this line item captures all of the cash flows so far with our property analysis. And I can get an IRR because I have that nice pretty stream of cash flows. And I find out that I got, well, let's make sure we show 2 decimal places. I've got a 15.55 levered IRR. And now this is before tax because we have not taken into account any taxation. But this is a really good spot to be in. We've made a lot of progress. So we're going to stop here and pick up with the taxation of our property. But let's just do a quick check here. 1555 IRR. Let's go to the next slide and look at the numbers here. And indeed, we got a 1555 IRR. So we've walked you through how to get that to that point. We've dealt with 3 of our 4 buckets. So we're going to stop here and pick up with the taxation bucket in the next video. Perhaps not the most fun, the most complicated. Not that it's terrible. It's nothing bad here. But if I focus in, pay attention one more time, we'll get to the end of it. So I'm going to stop here, and we will pick up with taxation in the next video.